Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. Got a full house today. We've got some results coming through. Maybe kick off with some good news. What's the good news? Oh, Elon Musk's got his first Neuralink brain implant. I don't think we've chatted about that one before. You've been following this one, Andrew?
I saw something briefly, but I haven't dug into it yet. Is it showing any promising early signs?
Yeah, I mean, I think it seems to be working. Hasn't caused any crazy damage or something. So yeah,
no one's died. Okay, That's a win.
And what else? I had one other one. Oh, just the Japanese moon lander, coming back to life. I think Japan had made I can't remember, it was like the most precise moon lander ever, but Japan joins the list of countries with a lander on the moon, which is kind of cool. What about you guys? Have you seen any good news around? No, just bad news.
The good news is always hyper local, though. That's the thing, right? Like,
you mean your personal good news, or
no? Like, look on the ABC, and it's even like, don't let their size fool you. Dachshunds. How do you say that? Dachshunds love being
sausage dogs.
Yeah, and
it's always a cute puppy.
Of,
it's always a puppy.
Yeah, and then it has a picture of like a puppy and stuff, and it's like literally like in all the world that ABC covers, and they're looking for some good news, and they're like, there is a puppy.
Yeah,
put it on the front page.
Very good. All right, well, we can just get straight into some company news this time, because there's been a few companies reporting, a few other things going on. Where did you want to jump into first, Claude? We're talking about a couple before the show. Do you want to chat Scali or Adacel?
Yeah. I thought we could start with Nick Scali, given that they just reported today as we're recording, and it's probably like the talk of the town today, because the results, from what I understand, it came in down 30% in terms of profit, but just like about $1 million or more, $1.5 million above, I guess, the guidance. So. I think that also implied that they'd had a stronger quarter than expected as well. So given the guidance was given, in the November AGM. So yeah, I don't know if Nick Scali is the best bellwether for the overall economy. Raymond's just published an article today on these results, and basically arguing that it's quite a remarkable retailer, because it really has a high performance culture in their sales employees, and they have high gross profit per employee, and essentially it's therefore a very well run retailer, one of his preferred retailers, I think. You can read the article for yourself, but the point is that it could just be that Nick Scali's special, or it could be that maybe the consumer's not as weak as people were worried about.
What a remarkable run it's had. Like in 6-7 months, shares are up close to 70%. We were talking at the time of there's undoubtedly some bargains in the retail space, because there was a lot of negativity priced in, and probably not unfairly so, but it's a good reminder that there are exceptions that prove the rule. And as I'll agree with Raymond, got to be one of the best retailers on the ASX, right? Like, there's a long history here of very, very significant shareholder wealth creation. And yeah, I haven't read the results yet, but credit where it's due. It's actually, despite all the doom and gloom, it's not that far off a record high from the share price perspective. It's about $14. I think it dipped. It's been above that previously, maybe even got to $16 at one stage, but only in the space of a few months. Other than that, this is about the highest the share price has been.
I was just basically going to say, I think it's interesting because, like Lovisa, it's like a leader in its category, and I think that as an investor, I like to collect businesses that I think have something special about them in terms of the quality of their business, or some secret sauce, some competitive advantage, or something that makes them better than other similar companies. And so that's why I like to follow Nick Scali.
Is there anything you think they do better that jumps out to you, or is it more like looking at the record of growth over such a long time?
I think that their position in the market probably is right, like a little bit premium. And obviously, I think the thesis that Raymond has, which I'm willing to believe, is that they have a strong, like a sales culture that really pushes their salespeople to get results. And that can be sometimes not ideal either as a salesperson or as a customer, but that's good for the business.
Yeah, nice. Yeah, I mean, they there's a few things about them that's different from furniture retail because they kind of make sales and then build the couches basically. So they don't have as many inventory problems as I think you might normally expect from a furniture retailer. Yeah, very. I don't know. I guess I think the reason the market's up. What is it up like 16% or something today on this news? So just today alone, and as you said, 70% over the last 6-7 months. On the face of it, looks pretty negative. NPAT net profit down 29%, but it just seems like it's probably that kind of turn in the second quarter. So September to December last year, it looks like the sales orders were not nearly as bad as people were expecting. Groups written sales orders for the period were up 1.1% on PCP. So there's this lag between sales orders and their revenue and profit, and it seems like something kind of turned, which I guess was kind of what we're seeing in like a bit of stuff with retail sales last year, where people had kind of taken the rate rises on the chin, maybe more than people were expecting, and employment or unemployment remained low, employment remained really strong. And then I guess you think with Nick Scali, maybe they skew a bit more to an older cohort which have benefited from rate rises rather than the mortgage bout. I mean, it's a bit of both, but probably some of it is that. So skewing to those there'll be some customers that are doing better than they would have been doing before with higher rates. So yeah, anyway, all that seemed to have turned the corner in the second quarter, and I guess that all that negativity is unwinding quite quickly.
You beat me to it, Matt. I think we too often look at these stats, and it's very easy to sort of think of things in a very homogeneous kind of way. But there's a lot of pain at the bottom end of the economic spectrum, and those at the top, like the worst case scenario is that my portfolio might be down a little bit. Like it's a vastly different experience. And those at the top who may not be having the second trip to Aspen this year or whatever, these are not the high-end retailers don't tend to suffer as much from that kind of stuff. And I think you can hold as an investor two truths in your mind at once, which is that there are, in a lot of ways, depending on whether you want to be the glass half full or glass half empty kind of guy, there are definitely genuinely things that you might want to worry about from a macro perspective. But yeah, those at an older age cohort, socioeconomic cohort, I don't think their decision to buy the leather couch for the holiday home is going to be influenced too much by that kind of thing. And this is my point is not to try and be classist or anything like that, but I think when you're looking at a retailer, you really want to have a very clear idea as to what segment they pitch at. And by relying just on broad economic measures, you're going to miss the story here. I don't know if anyone's seen the is it Malcolm Gladwell's chunky versus smooth pasta sauce, TED Talk.
Yeah, remind me on it. I remember seeing that a few years ago.
Oh, they did all, the pasta sauce manufacturers. I'm gonna really bastardize this, but we're trying to figure out what the consumer really wanted. And it turned out that there is no pasta sauce that meets everyone's demand. And it was a bifurcation there. It's kind of like crunchy or smooth peanut butter. What's the best? It depends. Some people like really crunchy. Some people like really smooth. So why don't we make a really ultra chunky one and a really super smooth one? And, it's not this idea that there is a product that just will appeal to everyone. And I actually see this lesson again and again as an investor, that the company that tries to be the everything to the everyman, generally not a great company. The company that exploits its chosen niche and understands their customer really well and happily turns sales away from those that aren't their chosen customer, I think tend to be the far better business as a general rule.
Yeah, that makes sense. Yeah, I guess, do you guys think it signals something more about the macro economy? A lot of people are waiting for Nick Scali as the first kind of retailer to report, or do you think it's more specific to them?
I've got sort of just thought on that. Is that I wonder I would want to know how much the people that shop at Nick Scali actually represent the overall economy. And yes. I probably need to just walk into a Nick Scali's store to answer that question, and the chances of me doing that are not super high. So perhaps one of our beloved listeners can put me in my place and correct me.
I mean, you would if you hadn't just renovated the 4 investment properties that you've got. And, the holiday homes.
I'm proudly investment property free since last year. Took me a while to get rid of that one. Yeah, no. It reminds me of this spoof Twitter account that isn't very active, but is always just managed to stick in my mind. That's called @MumAndDadInvest, and it's ostensibly for Barry and Susie, who are mum and dad investors of a certain retired age and some of their main interests are aside from, obviously opposing any reform to negative gearing is or discussing their SMSF investments is occasional tweets like this one. Dear Mr. Nick Scali Pty Ltd at Nick Scali Ltd. We have had some stains on our pleather L-shaped lounge that are immovable. Can you please let us know who to contact to deal with this? And one of the little recurring themes they have is their dealings with Nick Scali and obviously an important retailer for them. So I just wonder how close to the mark that is, because some of the other tropes that this account uses are probably reasonably on the market. So I don't know who the people buying the pleather L-shaped white lounges from Mr. Nick Scali, but if it is wealthier mum and dad investors, then probably their spending habits don't have that much to do with broader economy.
I suspect this is going to be a data point that people will point to strengthen any thesis they may have for various other ASX retailers. Like, look over there. It's not as bad as it see. I told you. And there may be some element of truth to that, but I would be very careful. Like if I was an investor in, I don't know, the Reject Shop or I don't know, something is just like, yeah, maybe, but these are extraordinarily different companies. So I always hate these sector classifications, or something gets called technology or this gets called retail. I mean, there are companies within these segments that could not be more different from one another. And you've got to be careful to sort of say, well, Bentley sales are really good, so, the next Toyota Hilux is going to be brilliant, right? Like it just, they're apples with oranges kind of comparison.
The difference as well is, though, is Nick Scali is on a lower multiple of earnings, whereas something like Lovisa, which is definitely a high quality retailer, is always on a higher multiple of earnings. Like somebody had told me, you got to look at Lovisa, at under $19. And I just got up the chart there, and sure enough, the thing dipped below $19 towards the end of last year, and it's shot right back up. And so, yeah, it's just interesting. It's for me, these are the leaders in retail, maybe JB Hi-Fi. So
yeah, shout out to JB.
Maybe the takeaway for this one, maybe the best analog is actually JB Hi-Fi, because that's shot up recently as well. That's up 20% in the last couple of months as well. But yeah, maybe that's the best analog, right? Because it's sort of not too high multiple, pretty high quality retail, pretty big. Maybe it probably catches a broader cross section of society though.
Yeah, that's a good point. Okay, cool. What else is catching your eyes result wise or anything else?
Well, maybe we'll do some results first, because I was just looking through, just generally as you mentioned last week, Matt, we've had the 4Cs come out, so thought we might chuck up a few for discussion, little small caps, micro caps no one else really talks about. And they're obviously, most of them are not that impressive. So then I thought I'd chuck in a company that I do actually think is interesting as well. So the first one I was going to cruise through is Pureprofile. Now, this is one that I'm pretty sure they've presented on Strawman. I honestly remember looking this back 10 years ago. It was slightly different story, but still the core business was the same kind of business, basically. What they essentially do is somebody pays them to do market research about their product or what product they should launch or whatever it is. The way that they charge for this has sort of changed over the years, and I guess they're trying to more make their business a little bit more recurring in nature than it previously was. I'm not really sure how well that works. They put a quarterly update out, not a cash flow that I saw, just something about revenue. And of course, this is a company that's very much a bit to excluding significant items, and they do have significant items. They even, in their Q2 FY 2024 highlights, which I thought was very interesting, they had a little chart that showed a bit to excluding significant items. So previously that had excluded non-cash share awards that were part of remuneration. And then they've even said, add back cash-based short-term incentive for FY 2024. So this time they paid actual cash, not shares, right? And then they've even added that back, so excluded that as well, to give a like-for-like EBITDA, which shows very, very mild growth. But of course, I would say none of this is actually real profit, and it is very, very much, I definitely don't think that anyone has data on their side when they say, oh, this is going to be a very profitable company, because it has many years worth of operating on the ASX and has consistently struggled. And it has if I just bring up ComSec, the net profit after abnormals, in the last 10 years, I see 1 year where they made a profit. So whilst I do think that it's possible that this company has a better result or gets an actual profit 1 year or even 2 years, I think that the one thing we can really take away is that it's going to be quite changeable. It's not really recurring revenue in business. Like, there's going to be differing demand from year to year based on a whole number of factors. And, certainly I guess certainly I don't take that much confidence from the fact that they also had the CEO and CFO, I think it was, sold shares recently. Now, I hasten to add the share sales are to fund personal tax liabilities resulting from share-based remuneration payments relating to the long-term and short-term incentive programs over the last 3 years. But after that, the CEO only owns 3% of the company, and it's not a super large company. So it doesn't exactly fill me with confidence. I do think that the thing that I would add is you got to be aware with this company is it can have a couple of years of better results. It's possible for that to happen. But I just think you need to look at the overall business and be like, why do you think that after 10 years or whatever, what would make anyone feel sure that this is actually going to be a consistently profitable company?
Yeah, it strikes me as one that's naturally going to be hypercyclical, which is not necessarily a problem, but bear in mind. My issue is I'm just not very bright, and I'm not familiar with the industry, the value prop when you cut away a lot of the hyperbole in the words in bringing insight and vision to the world through data analytics. And what does that mean? I don't know. And there'll be people screaming at their phone right now going, it's not that hard, dumbass. But for me, it's always going to keep me at bay.
I don't think anyone who's held Pureprofile shares for very long is in a position to call anyone else a dumbass.
I see your Pureprofile and I raise you many micro-cap dogs. Don't you worry.
Yeah. I've got a few of those myself, but nobody's calling anyone a dumbass is my point.
No.
These things happen in macros.
It just does. And I guess as I have matured, if I can use that word with a straight face, as an investor, I've really grown to favor simplicity. And it's the whole Buffett thing, there's no extra points for degree of difficulty with this stuff. And yeah, it's so outside of my circle of competence. It's interesting. I know someone on Strawman made the note recently that they've cut away some of the dead wood. They've optimized it. There's a reasonable position here. They could do extremely well from here, but I don't know how to handicap that. Do you guys have a solution for me?
Yeah, I mean, I guess the advertising world in the small, there's a few different companies that play in like programmatic online advertising, small cap businesses, and it's just very, very hard. It's just that you're up against such huge scale, and the whole kind of market is very opaque, as in it's intentionally a black box because a lot of the businesses really rely on some arbitrage there. They're arbitraging something. I mean, all of online advertising is arbitraging some attention for something else. And so you can have these edges that then disappear. You can have like favorable circumstances. I think Pureprofile was benefiting a bit, or at least investor sentiment, from Apple's anti-tracking laws that came in a couple of years ago. And there's kind of, maybe we need first-party data like what Pureprofile has. But yeah, it just shifts so fast. And it's really hard to have an enduring advantage. I've looked at maybe 5 or 6 of these things. And yeah, I don't think I've found anything ever that has an enduring advantage. You're just always getting stomped by giants.
But the thing is, I think the right prism to look at this through in any event is more like an IT consulting company, not like a software company. I think that's the key. That yes, they do have this kind of asset, which is, I guess, this network of people they can ask about things. But a lot of their business is research service, reporting and analytics and that kind of thing. And, that to me is a huge amount of that is just basically there's some sort of expert there that's looking at the data and maybe putting it through whatever framework they have and trying to give you takeaways. And to me, that should be viewed as, it's essentially you've got a skilled person who's being rented out in a way. And that kind of business model is far more consistent with their actual results. Like their results are not that consistent with some kind of strong asset that they're just making money off. Like I'll read you, their revenues in the last 10 years. I'm going to just say the whole number, not the point, whatever, but 9, 27, 52, 52, 26. I think they've invested something 24, 30, 42, 43. So you can see it kind of can move around a bit. And in the last year was only like pretty much flat. So yeah, well,
in that same time frame, you've got to lift the shares outstanding from 88 million to 1,133
exactly.
million.
Yeah, exactly.
So,
but I can only assume that the next step will be again to raise capital, because if you're going to lose money endlessly, then you're going to need to raise capital at some point. And, they should be still fine for a while, I guess. Look, they have, in the last balance sheet date, 4.7 million cash and 3 million in borrowings. Now, borrowings is generally something that would lead me to avoid a stock when it's this small and not profitable. That is, obviously, I don't mind if it's a profitable, stable business. But, the balance sheet hardly sings heaps of strength. And on top of that, that debt they do have, interest is fixed and payable at 8.5% per annum and payable quarterly on the last day of the quarter. So why are you paying, yes, they do have cash, but why are you paying interest if you don't need that debt? So overall, I would just say, yeah, it's the kind of business that I'd look to buy on a low multiple of profits, essentially. So it's never really made sense to me how it manages to keep on raising capital. But I have no doubt that there will be more capital be raised, because it seems to be that all you really need is some revenue and you can raise capital on the ASX.
I mean, I don't want to be unfair, because everything's a challenge until it's not. You throw a lot of stuff at the wall as an entrepreneur. Something sticks, something doesn't. It's normal. So it's very easy to sort of sit from afar and throw shade. But this is a company with a market cap of 29 million. And you look at that same balance sheet, Claude, and they've got 61 almost million in accumulated losses. That is a lot of money that has been put into this entity to
that
present.
had flat revenue as well. It's not like there's some rocket going off.
No, there's not a. So you over the years, shareholders have put in over $60 million for a company whose net assets now are less than $4.5 million and is losing money still. Now, again, it is a little bit unfair. I mean, it is. You could point to some hyper successful companies that sort of went through these challenging phases and finally nailed it and sawed out the other side. But it is perhaps a pointer towards the difficulties of operating in this industry.
Yeah, for sure. Anyway, so moving on, I thought I'd bring to your table to hear you guys' thoughts on another fairly small company, actually, $60 million market cap. So perhaps double the size-ish, that I own shares in, by way of disclosure, is called Adacel. And now I'm sure long-term readers and stuff will be familiar with this stock because it has had its day in the sun a few years ago now, from which it fell pretty hard. At a high level, the story is that a few years ago now, I forget the actual year, it might have been 2018, they lost a big contract with the FAA. What these guys do is they provide some air traffic control software, but also air traffic control tower simulation systems. And what they announced in October last year was that they were awarded the new FAA contract for the tower simulation system and support and technical refresh. Now, I don't know what the exact margins on this business will be, because the reality is that basically when they sell the systems, it's lower margin than the sort of services and support kind of side of things. So yeah, essentially you don't know the exact result that it will have on profit, but it is USD 59 million over 5 years. So that's more than 10 million USD per year on average that's going to be added. And I think it is fair to say that this is meaningful in the context of Adacel's overall revenue, because consolidated revenues in FY 2023 were 27 million. So even just doing back of the napkin kind of calculations, you can see it's it's potentially a 30% increase in the business. So of course the thesis is just that this company will enjoy some operating leverage in the next few years as this big new contract that they've won back flows through. As it becomes more profitable, it will look less bad, basically. And at the moment, it has had a couple of unprofitable years. In the past, when it had this contract before, it was reasonably profitable. And so I don't think that this is some sort of fantastic buy and hold long-term story, grow to the sky kind of thing. I just think that it might be too cheap in light of the fact that this contract hasn't flowed through yet.
Yeah, this is an interesting one. I've not looked at it closely, but I mean, just to give some contrast with Pureprofile, you've seen the share count flat. In fact, you've seen the share count diminish over the last 10 years or so, which is okay, that's interesting. So they've been entirely self-funded. I don't know if there's any debt there, Claude. Knowing you, probably not.
No. They're clear. It's not like there's any. I don't think there's any real chance that they go bankrupt. The question is, though, are they that good a business, or are they just a business that it's just the high level thing I told you, just encapsulates my feelings about them. Is they lost a contract, they won back a contract. That's obviously not something that the highest quality business in the world does. In terms of debt, no. If you don't include lease liabilities, then there's no debt. But their balance sheet is pretty skinny as well. So they have a potential bank overdraft and that kind of thing as well. So I wouldn't say they're massively strong when it comes to the balance sheet. But again, ultimately what the thesis is that things are about to get better for them because of this contract. Now, I hasten to add, I don't think that that's going to come through in these current results because the contract only begins on the 1st of December 2023. So the results that come out in February won't really have much of an impact from that at all. But according to their guidance, they should be returning to profitability anyway, but typically, of course, with a stronger second half. So that does make sense in terms of them having the full half from this new contract in the next half. But at the same time, you got to take that guidance with a massive grain of salt, as they have missed guidance on previous occasions.
Yeah, I think that thesis makes sense. I'd owned this one many years ago. I think bought it buying around these levels, and it went all the way up to $3 and eventually came back down. And I think the difference at the time, I was expecting it to become a higher quality business as it kind of won these new contracts, but the business itself just wasn't, at the time at least, that high quality. And I guess you'd say probably still isn't. Like, just a lot of the things that we like to look for in a software company is probably a good lesson in technical debt that it had, and just hadn't really productized to have one platform like a SaaS company. It was kind of moving away from being spaghetti code, not even modularized, let alone kind of individual products, as more bespoke software for each company. So yeah, I guess that's the danger. That's a kind of highlights a danger with software companies that have been around a long time, is how easily they can have technical debt or things that you'd assume a software company wouldn't have if you're used to looking at a lot of recently founded businesses. But at the flip side, that's what you need to compete in some domains, is having that long legacy. So you can kind of have these businesses that exist for a very long time without having a lot of attributes that you like. So yeah, something
but I do agree fully with that. Like, it's hardly perfect. Like, I mean, obviously you get the real upside when something transitions from not so good quality to good quality. But the only sign that might be happening is they won back this contract. But I wouldn't have high hopes of that, given that they haven't invested that much into software development that I'm aware of. So yeah, I think that's all fair. But yeah, nonetheless, probably a testament to the way that software can hang around for a long time.
Yep, no, that's a great point as well. What about you, Andrew? What's been on your radar?
Actually, just before jumped on this pod, I had a chat with Jerry Sakis from Playside. We did an interview with Strawman. Playside, for those that don't know, are a games development studio. They make computer games, and they've got a pretty interesting business model. So they have this work for hire segment. So big studios will give them some work to help provide them with a little bit of flex. And that's nice. It's nice, sort of pretty reliable kind of revenue. But they're also doing their own original IP. And that's the moonshot kind of stuff. And so I'll back up a little bit here. So Jerry's I really like him. I mean, I came away from the call and I think, God, I did it again. I was a gushing fanboy. Like, this is not a hardball interview. And I am cognizant of that. So apologies to any members where I might have been a bit too gushing, but so he worked as a games developer, project lead at EA Development Studios down in Melbourne for a while, for 3 or 4 years. Up until 2011, they closed his studio down. And so him and some friends got together and started working on some mobile games, started winning a bit of work. Business grew really well. They listed about 3 years ago. I want to say their first year worth of revenue was around 10 million. And they're on track to do 60 to 65 million this year. And that's gone up pretty consistently. I think it was 40 million last year. So their revenue is going really, really strongly. But they've actually now cash flow positive. They've got an EBITDA margin of around 20%. Present was where they're likely to end up for FY24. And they're sitting on almost 40 million in cash. And there's still a big, strong pipeline of work that's there. So this is a good setup in the sense that this is not a business that's desperate to raise capital and is sort of like lurching from one quarter to the next. This is pretty profitable. Jerry has obviously been there from the get-go. He's the founder, he's a major shareholder, but also the initial team that he brought from EA are all largely there as well. And I think for me, what's attractive is that you've got to understand the nature of this industry. It is massive, bigger than Hollywood, right? Like it is a global market. It's very competitive, but what I think a lot of investors miss, and this is the point that I kind of hammered in the call, is that when you get a bit of IP that works, the tail on that is so long. Jerry himself gave the example of Angry Birds, which was one of the very first games that sort of came out on the iPhone with the touchscreen back in the day. I believe it was a small Kiwi development studio, and they've now got movies.
Angry Birds wasn't Kiwi. Angry Birds was like Swedish or something.
Who am I? Oh, maybe I'm thinking of Fruit Ninja.
Yeah, I don't know.
Yeah, okay, yes, thanks.
I'm
you
sure I
would have
talk for
claimed
many
it
people
otherwise. Yeah.
I would have claimed
when I
it for
say
sure.
I have no idea what Fruit Ninja is.
What?
Nah,
Okay.
never heard of it.
Oh, really? I'm surprised. Yeah, it's fun for like 5 minutes. Anyway, but that IP, when it hits, and Jerry's the first to sort of point out that a lot of them won't. It's a bit like VC investing. You sort of, you throw a lot of stuff there and then something hits or it doesn't. So they made the move into PC titles not too long ago. Age of Darkness was their first sort of real crack at that. And it's done really well. If anyone is a gamer, jump onto Steam and look at the reviews. They're really good. So they've got form. They've signed a deal recently with Warner Brothers and other very big studios. They absolutely shot it out of the park with the Dumb Ways to Die franchise. They bought that. And again, there's a lot of optionality around that. We could talk about sort of the NFT mint that they just timed to perfection. Let's not get into an NFT discussion. I think they're a waste of time, but they read the room very effectively and they raised a lot of money on the back of that. But the point is here that I think is that you've got a business with a pretty good base of it's in an industry with a very strong tailwind. It's likely to grow, is growing very strongly, with a very good base of work that is got a bit of form on their own IP development and is acquiring IP as well, and has the ability to generate a lot of very good revenue over a very long period of time, if any of those manage to get any particular traction. And it's very clear from talking to him that he's extraordinarily engaged. A lot of CEOs talk about culture and whatnot, and it's sort of one of those wishy-washy things you think, yeah, whatever. But it's kind of like, I kind of believe it when Jerry talks about it. He's clearly passionate about it. They have managed this hyper growth and done it in a financially responsible way towards their shareholders, I think is on the level. So yeah. Do you guys have any thoughts on it? Oh, I own a bit of shares. I own some small shares.
Yeah, we've held that in the fund since before IPO. Yeah, I think it had some really strong positive announcements with the recent quarterlies and the recent signing under the publishing division. Yeah, I mean it's got a fair bit of growth to go, like to justify the current market cap and valuation and stuff. But yeah, doing a lot of the right things. So yeah, I think it's put that one in the positive updates for this quarterly for sure.
Do you know one of the things that really resonated for me too was that I get the sense he's a guy who likes to push back on the brokers and the analysts who are pretty hyper obsessed with short-term quarter-on-quarter kind of thing. They've done a lot to foster. I think the support they have from the fundies who hold it. They've done a lot of work there. They've got the right kind of investors on that front. They're there for a long time, not necessarily just a short and good time. And he seems to be mapping things out over many, many years. They're easily one of the biggest game development studios in the country. And again, they started in 2011, like with a few people in a garage, sort of proverbially. And there is something nice to see a passionate founder, very culture oriented, who believes in the games and it's games first. And you can see from his LinkedIn profile, he's sort of out there playing different games and writing reviews with nothing to do with what Playside is sort of doing. So he lives and breathes this stuff, and his enthusiasm was very catching. But yeah, I mean, there's quite a bit of expectation in the price.
Yeah, that's what scared me out of it. I actually used to own shares in it, and to my detriment, sold. I think it's done okay since then, or even well. So I definitely didn't. I wasn't smart about it, but at the same time, yeah, that's the only thing I've struggled with on it is the valuation. And I think actually in the most recent one, you guys can correct me if I'm wrong, but I think that they had good news with regards to their own IP revenues. And, that is ultimately where I see, that's a big increase that they had versus the prior corresponding period anyway. So overall, yeah, like that to me is a good sign. And that is the thing that I'm looking for to improve the quality of the overall business. I think probably where I disagree with other people in the market is I think really the real thing that you're looking to invest in is the original IP revenue. That's where you get some sort of where you could really justify a high multiple. The work for hire stuff, like that is, I think, should be seen through the prism of, you'd only value that revenue at like 15 times earnings or 20 times earnings, or look, if you thought it was growing really fast, 25 times earnings. So that's kind of where I've not gone along for the ride, but that doesn't mean I'm right. And also that it is good to see that IP revenue going up.
Yeah, very good.
Yeah.
Some other good news was Janison, which we talked about before. It struggles. So they've just won a major new contract. Claude, do you have the details in front of you? I think it was New South Wales Education, kind of like a screening exam for to see kind of high potential kids, if that's right.
Yeah, so the announcement was that the agreement is expected to generate revenue of up to 45 million over the initial 5-year term, provided all stages are approved, with an option for the department to extend for a further 5-year term. And essentially, Janison expects work to commence on the new platform and services in early 2024, with key deliverables including the digitization of test administration procedures, the development of on-demand practice test environment, the implementation, configuration, and piloting of delivery program. Janison expects pilots of the new program to be concluded in 2024. A full rollout of the digital assessment platform will be completed in 2025. So to me, this says this is another contract that is super boutique in nature. It's not like they've just say, oh yeah, here's your login to our software platform and off we go. Far from it. To have 1 year of it's going to take us a year to get to the end of pilot stage definitely shows that if you're looking for this looks like Adacel is the same kind of thing, right? Basically. And I'm talking about, Adacel has a market cap of 60 million and has been unprofitable for a couple of years after the last 10. Janison has yet to make a profit and has it had a similar market cap, and now it has a $90 million market cap. So unpacking it a bit, I thought the result this morning was extreme. So for starters, obviously 45 million over 5 years is around 9 million per year on average. And the FY 2023 revenue was 41 million. So the increase is about 22%. I think that's a good increase, but I also would be thinking of this revenue more as sort of project style revenue. I'm not sure what the profit margins would be, but again, it's not going to be some situation where, you just give someone a login and it's basically all the incremental revenues falling to the bottom line. From the description, it sounds like it's definitely not that. So a positive, but is it plus 50% positive? I'm less sure about that. That's for sure. So yeah, ultimately, I think that, I'm very happy for shareholders. I think it was really depressed there, the share price, for a bit. So seeing it pop up now, I think that the share price is probably actually, with a 50% rise today, I think it might have gone from
about 90 million market cap. I think
it makes a big difference. To me, I could definitely see more the case for why you'd be long this at 60 million than 90 million, put it that way.
Yeah. I mean, I have a very low view of the Department of Education in New South Wales. But this is not necessarily a bad thing against Janison, right? I mean, you want a counterparty that is perhaps you have an edge over. So I don't know.
Yeah, so I guess why was the share? I mean, it had been pretty beaten up in terms of people's sentiment towards it. I mean, keep in mind this is a stock that was worth vastly more. I guess whatever it be, well over $1. It's back up to 40 cents. So I guess maybe it's just like two things. One is a direct revenue component. I don't think that in itself validates that much of a market cap move, because as you said, it was also a competitive tender process, right? So I've seen some broker notes are like, oh, that's a great sign because it means that they're winning in competitive tenders. And the other side is like, well, is it a great sign because then they have to compete in the tender and probably, maybe they're not making as much margin on it. I'd much rather my companies not be having competitive tenders to win their contracts. So we don't know what the margins are. We don't know how much of that is like service and integration work versus like an ongoing SaaS, more like SaaS revenue. It's never quite SaaS, Janison. Well, some of their work is SaaS, but a lot of their work isn't. A lot of the work still has some more kind of higher cost real world requirements. So yeah, but I guess the signal that it sends, things may be turning around, sentiment's really beaten up. I don't think this is a thing where there's probably like huge amounts of short interest. I'm saying that off the top of my head without checking, but I do think it's a thing where it's just been really beaten up and not had any good news for a while. But there were still a lot of brokers who were liking it and covering it and hadn't really, it had happened so fast, the fall. I think this has probably been seen as like good news. Hey, we were right to stick in this one. So yeah, I'd want to see a few more wins like that to see that something had changed in the company's ability to grow quickly at high margins. I think that was probably what I'd owned this one before, as I think I talked about, and what I got wrong at least thankfully sold, I think, higher than the price it's trading today. But I'd basically expected it to transition to be more like a traditional SaaS company, and it had still been stuck with a lot of the challenges that you have selling into education and not having like a one product for every customer, all those challenges. That's what you want to see change over the next few years if you're bullish, Janison.
I'm so concerned about my own lack of success investing in companies that have government as their main customer. Like I've had more misses than successes in that. And, it even makes me paranoid for my one holding that does have a fair bit of their customers being governments.
Is that Alcidion?
Oh, no, sorry. That's the other, my one good one I meant. Yeah, the Alcidion, which I own, is the bad one, which I'm like, oh, God, what have I done? Like, essentially, the long story short is that they were supposed to sell contracts to the NHS, but the NHS, didn't follow its own timeline for procurement, which I still hold that, but it's been very, very
It's not their fault. I mean, you've got to be careful not to divulge into a different topic, but the NHS is a basket case, right?
There are other much more successful companies that do sell into government. I'll use an example, and education, by the way. I'll use an example that I don't personally own, but that I think is a good example, which is Technology One. Why is it that Technology One has had so much success in education, in government, whereas these other companies just absolutely can't make it work? And Technology One has been such a long-term success story in selling into education and government as huge sectors. So I think, there's some real value add for someone out there who can crack that case, who can figure out, look, how do I pick the companies that are going to be really good at selling into these kind of difficult industries, or these difficult sectors, I should say?
It's a great question. My thoughts are that I think government is a very difficult counterparty when you're early. Getting those first deals across the line is just, so painful. If you've ever had to deal with any large bureaucracy, I mean, you wouldn't put your worst enemy through it. The flip side of that, though, is that once you're in, right? The DOE is not changing providers anytime soon. And even if they, for whatever reason, decide that they want to, 400 meetings and, 1,000 years later, they might finally get around to it. So the inertia in these organizations is profound. And that's a negative at first, but it's a positive on the other side. Another example is 8 Common, right? So they've spoken to Andrew Bond, I think, is the CEO there, and makes the exact same point, really hard. But then the other thing is that there's nothing quite like what's the term for it? It's sort of like it's a name and it's just escaped me. But this is the answer to your question on Technology One, why is it that they've been successful? Because they can point to a lot of examples where they have successfully integrated. So the bureaucrat that's having to make the capital allocation decision is really mainly concerned with covering their bum, right? It's not their money. They're still going to get paid at the end. And what do you have here? It's am I going to go with something that's unknown and untested, or am I going to go something which umpteen other departments have integrated and have had success with? And they're Australian. There's a political dimension to all of this as well. So I think when you can get your foot in the door, when you can sort of lower the risk of choice for the decision maker from a bum covering exercise, there's something to be said there. I think there's a real advantage to be had, but it is a hard chasm to cross.
Do you think it's just a matter? Should you just wait until they're bigger? Wait until they're 500 million market cap, rather than being the small caps that are struggling? Not market caps, obviously a proxy for the business size, but you get what I'm saying.
I would be more comfortable on that. Yes, that's a harder one. I'm actually very bullish as a category on online education. I mean, that is a sector that is just so ripe for disruption. It's not funny. Yeah, but it's...
Yeah, but you can't buy OpenAI.
Right.
Maybe that's the disruption, right?
Right.
That's kind of what I'm saying. It's all the small, just how hard it is for small caps with those big customers. I think
that's it, man. We've talked about on the pod before, my own personal tutor who's Einstein level physics. Or
hey, we haven't actually talked about, I don't think we talked about the voice version of ChatGPT that much, did we?
No.
We haven't, because I didn't even know about it.
Okay, so I started using it. It came out a little while ago. Have you seen the movie Her with Scarlett Johansson?
Great
right?
Movie.
Have you seen it, Claude?
Yeah, I have. Yeah.
So the voice assistant is extremely good, and they've got one that clearly sounds like Scarlett Johansson. Just by the way, this is someone there. I feel like they're infringing on her rights. Anything else you guys wanted to talk about?
Yeah, yes, I do have something though. I wanted to say my thing I was grateful for, which is the smell of my baby daughter's head. I think that the endorphins or whatever come out the top of her head, they really like hit some sort of level, very calming for me.
Smells better than the other end, right?
Yeah, definitely. And also, I'm psyched to hear what you're grateful for, Andrew.
Me?
Yeah.
Yeah, you've had 2 weeks now to think of something that's actually positive.
Oh, gosh. You go first, Matt. I got to
How
think.
how about the awesome house you bought? Are you grateful for that?
Oh, official.
Well, it's not official.
Oh, it's not official.
No.
So when it's done, can you guys, like, at the end of an episode, so people can switch off, give me 10 minutes just to rant on this experience? Because I'll say the TLDR is that anyone out there who's going through this process.
No, don't say anything now. It's not done yet. It's not done yet.
Okay.
Let's just keep
It's almost done.
For another episode. Some other episode, I'll say what I'm grateful for. Then Andrew will go into a rant about whatever. And for the people that enjoy Andrew's rant, which is probably like, I think there's a few people that do, Andrew. I think that,
Well, there's a bit of Schadenfreude maybe, but all I will say, come the zombie apocalypse,
Say what you're grateful.
I'm grateful for the fact that when the zombies come, I've got a great place to defend against the zombies. So you guys are welcome to come join me in the bunker.
I'll take it. We're going to get you all the way to gratitude by the end of the year, but I'll take that. That's a step in the right direction.
Nice.
All right. Should we wrap it there?
Wait, what about Matt?
Yeah,
Matt, thousands of things.
Yeah.
Health.
But pick one.
Although I'm sick.
Health.
You don't seem that healthy,
Sunshine.
man. I'm just looking at you right now, and you don't.
Yeah, but you can be
he's got
immensely
enough
sicker,
health.
man. Yeah, exactly.
Yeah, and maybe that's a good thing to be grateful for. That'll tell your little cells that they're healthy and that'll make you feel better.
Damn you guys and your bloody optimism! Like, what's wrong with you?
Yeah, I like that. I like that one. The ability to heal like that. All right, let's wrap it there, gents. Hit us up on Twitter @BabyGiantsPod. Until next time, thanks very much for listening.
Thanks for listening, everyone. Thanks.